The screen says $32. The banks say $32. Kitco says $30. But when you open your wallet, when you pull out real cash and try to buy that $32 silver, the dealer looks at you and says $38, not $32.50, not $33, $38. That is a $6 gap. That is an 18% premium. Now, that is the difference between what they tell you silver costs and what silver actually costs. They want you to believe the market is fair. They want you to believe the price you see is the price you pay. They want you to believe that when CNBC flashes $32 on the screen, that is the real cost of an ounce of silver. They are lying to you. Not a small lie, not a rounding error. This is a systematic deception so embedded in the financial system that most investors don't even know they're being scammed. While you were checking your portfolio app yesterday, like while you were reading headlines about precious metals markets, while you were watching the Comex ticker climb from 31.80 to 32.10 and thinking, maybe I should buy, something was happening in the real world that makes that screen price completely meaningless. Dealers across North America, Europe, and Asia were selling silver, but they weren't selling it for $30. They were selling it for $38, for $39. Some were asking $40 for immediate delivery of American Silver Eagles. The gap between the paper price and the physical price has blown open so wide that it now has a name: the Great Disconnect. But Bloomberg isn't reporting this. The financial advisors aren't warning you about this. The banks certainly aren't telling you about this, because they need you to believe in the screen price. They need you to think that silver is $32. They need you to keep your money in their system, watching their numbers, trusting their data. But here's the detail they're hiding from you. Here's the detail that changes everything about how you should think about precious metals. Here's the detail that proves the entire pricing system is a fraud. The number on your screen and the number on the dealer's invoice are no longer connected. One is a fantasy, a digital illusion printed by algorithms that have no metal. The other is reality, the actual cost of acquiring physical silver in your hand. And the gap between them is getting wider every single day. In this comprehensive investigation, I'm going to expose exactly why this disconnect exists. I'm going to walk you through the mechanics of the two-market system, how the paper market and the physical market operate in completely different universes. I am going to show you why dealers must charge premiums, why they cannot sell at spot price without going bankrupt. I'm going to reveal the hidden costs, the supply chain bottlenecks, and the inventory crisis that make $32 silver impossible to deliver. And I am going to prove to you, using simple math and dealer economics, why this gap will never close, why it will only get wider. The banks show you $32 because that's the price of a promise. The dealers charge you $38 because that's the price of metal. One is paper, one is physics, and physics always wins. This is the story of the Great Disconnect, and by the end of this video, you will never trust a screen price again. Number 2, the two worlds of silver. If you just watched part 1, you now know that the price on your screen is not the price you pay. You know that dealers are charging $38 while banks show $32. But now we have to go deeper. We have to answer the question, why? Why does this gap exist? Is it greed? Is it conspiracy? Or is there a structural reason that the physical price must be higher than the paper price? In part 2, we're going to dissect the two-market system. I'm going to show you how the paper silver market works, how the physical silver market works, and why they can never meet. This is the ugly truth behind the pricing system. Let's start with the number you see. $30. Where does that come from? It comes from the Comex, the Commodities Exchange in New York. This is where silver futures contracts are traded. These are not physical bars. These are contracts, promises to deliver silver at a future date. Here's how it works. A hedge fund wants exposure to silver. They don't want to store 5,000 ounces in a vault. They just want to bet on the price. So they buy a futures contract. They put down maybe $8,000 as margin. On the other side of that trade is a bullion bank, JP Morgan, HSBC. They sell the contract. They promise to deliver the silver if the hedge fund demands it. But here's the secret. They know the hedge fund will never demand delivery. 98% of all futures contracts are settled in cash. Nobody takes the metal. It's a paper game. So the bank sells contracts backed by metal they don't have. The price is discovered by millions of these paper trades happening every second. High-frequency algorithms, speculators, day traders, none of them want silver. They want dollars. They want to flip the contract for profit. This is the paper market. It is fast. It is liquid. It is leveraged. And it has almost nothing to do with actual silver. The price you see, $32, is the price of the paper promise, not the price of the metal. Now let's talk about the other world, the world where metal actually moves. This is the dealer's world, and the economics here are completely different. A dealer wants to sell you a silver coin. an American eagle, a Canadian maple leaf. Where does that coin come from? It comes from a mint, the US Mint, the Royal Canadian Mint, the Perth Mint. These mints buy silver from wholesalers. The wholesalers buy from refiners. The refiners buy from miners. This is a long, slow physical supply chain. It involves trucks, vaults, security, insurance, electricity, labor. Every step in this chain costs money, and every step in this chain takes time. Let's say the US Mint buys silver at the spot price of $32. They don't just hand you a bar. They have to melt it, refine it, strike it into a coin, package it, ship it. That costs money. Estimate $2 to $3 per coin in minting costs. Now the coin goes to a wholesaler. The wholesaler has to store it in a vault, insure it, pay employees to manage inventory. That adds another $1 to $2. Now the coin goes to a dealer. The dealer has to run a website, pay for payment processing, handle customer service, ship the coin to you with tracking and insurance. That's another $1 to $2. Add it all up. The $32 spot price becomes $38 by the time it reaches your mailbox. That's not greed. That's the cost of moving physical metal through the real world. But here's the trap. The dealer bought that coin from the wholesaler maybe 2 weeks ago. Back when spot was $31, they paid the wholesaler $37 per coin. Now spot is $32. They're selling it to you for $38. If they sold it for $32, they would lose $5 per coin. They would go bankrupt in a week. So the dealer is locked into the old cost structure. They cannot drop their price just because the paper market ticked down 50 cents. They are selling physical metal with physical costs in a world that moves at the speed of trucks, not algorithms. This is why the disconnect exists. The paper market is instant. The physical market is slow, and slow costs money. Now add one more element to this equation. Supply. In a normal market, if the premium gets too high, more supply enters to capture that profit. If dealers are selling coins at $38 and spot is $32, new dealers should flood the market, right? Wrong. Because there is no flood of supply, the mints are rationing, the US Mint has allocation programs. They limit how many coins any single dealer can buy per week. Why? Because they can't produce enough. The demand is too high. The blanks, the raw silver discs they strike into coins are delayed. The refining capacity is maxed out. So the dealer can't just order more inventory. They're stuck with what they have. And what they have is expensive. They bought it weeks ago at higher prices. They have no choice but to charge a premium to cover their costs. This creates a one-way valve. When spot goes up, dealers raise prices immediately. They have to. Their replacement cost just went up. But when spot goes down, dealers can't lower prices. They're still selling old inventory they bought at the peak. The result is a ratchet effect. Premiums go up fast. They come down slow, or they don't come down at all. We are currently in a cycle where premiums have been elevated for months. The US Mint sold over 30 million Silver Eagles last year. That's near record demand. But production capacity hasn't increased. The system is straining. And when the system strains, premiums explode. The $6 gap you're seeing today is not temporary. It's structural. It's the new normal. Let's talk about the elephant in the room. If the Comex says silver is $32, why don't dealers just buy from the Comex? Because the Comex doesn't sell coins. The Comex sells 1,000-ounce bars, industrial bars. If you're a dealer and you want to sell American Eagles, you can't just buy a Comex bar and hand it to a customer. You have to send that bar to a refiner. The refiner melts it down. They pour it into smaller molds. Then they send it to a mint. The mint strikes it into coins. Then it goes to a wholesaler. Then to you. That process takes months, and it costs money at every step. By the time that Comex bar becomes a retail coin, the $32 spot price has become $38 or $40 or more. The Comex price is a wholesale industrial future delivery price. It's not a retail coin immediate delivery price. Comparing the two is like comparing the price of crude oil to the price of gasoline at the pump. They're related, but they're not the same. The system is designed to make you think you can buy silver for $32. But you can't. You never could. That number is a benchmark for industrial contracts. It was never meant to reflect the cost of a coin in your hand. And now, in an era of high demand and constrained supply, that gap has become undeniable. So here we are. The banks show $32 on the screen. It's a number generated by paper contracts, high-frequency trading, and leverage. It has almost nothing to do with physical metal. The dealers charge $38. It's a number generated by real costs, constrained supply, and physical logistics. It reflects the actual price of moving metal from the ground to your hand. One is fantasy, one is reality, and the gap between them is the great disconnect. But if this disconnect is structural, if it's just the cost of doing business, why am I calling it a scam? Because the banks and the media are hiding the truth. They show you $32 and tell you that's the price of silver. They don't tell you about the premium. They don't warn you that you can't actually buy at that price. They let you believe the illusion, and when you finally try to buy and see the real cost, you feel cheated. You feel like the dealer is ripping you off. But the dealer isn't the villain. The dealer is just surviving in a broken system. The villain is the paper market that pretends metal is abundant and cheap when it's actually scarce and expensive. In part 3, I'm going to show you what happens when this disconnect reaches a breaking point. I'm going to walk you through the math of a supply crisis. And I'm going to explain why the 6 premium today could become a 10 premium tomorrow, or a $20 premium. Or the day when there is no premium because there is no metal at any price, the disconnect is widening, and widening gaps eventually become canyons. Don't go anywhere. This gets darker. Number 3, the math of collapse. If you've been with me through parts 1 and 2, you'll now understand the 2 market system. You understand why the paper price is $32 and the physical price is $38. You understand that this is not temporary, it's structural. But now we have to ask the terrifying question. What happens when the gap keeps widening? What happens when premiums go from $6 to $10 to $15? What happens when the physical market completely detaches from the paper market? In part 3, I'm going to run the math of extinction. I'm going to show you how the supply squeeze accelerates. And I'm going to explain why the dealers who are charging $38 today might not have any silver to sell tomorrow at any price. Let's start with demand. Who is buying silver? 2 groups, industrial users and retail investors. The industrial users, they buy 1,000-ounce bars from wholesalers or directly from refiners. They use silver to make solar panels, circuit boards, medical devices. They need it. They don't care if the price is $30 or $38. They care about securing supply. When they see premiums rising, they don't wait. They stockpile. They lock in contracts for future delivery. They remove silver from the market and put it into inventory. Then there's retail investors. People like you. You want coins, bars. You're not buying 1,000 ounces. You're buying 10 ounces, 50 ounces, 100 ounces. You're stacking. And when you see the price at $32 and premiums at $6, you think, that's high, but I'll buy a little. You remove a few ounces from circulation, multiply that by 1 million people. Millions of ounces are being pulled out of the retail market every month. Here's the problem. The refiners and mints can only produce so much. Let's say global refining capacity for retail silver, coins, and small bars is about 150 million ounces per year. That sounds like a lot. But demand last year was over 200 million ounces. There's a 50 million ounce gap. Where does that 50 million come from? It comes from old inventory. It comes from dealers selling stock they've been holding for years. It comes from recycling, people selling their old coins back to dealers. But what happens when the old inventory is gone? What happens when the recycling supply dries up because nobody wants to sell silver at $32 when they know premiums are $6 and rising? The supply gap becomes a supply crisis. Now let's talk about the dealer's nightmare. Imagine you are a silver dealer. You have 10,000 ounces of inventory. You bought it months ago at an average cost of $35 per ounce. You're selling it today for $38. You're making $3 per ounce profit. That's a thin margin, but you're surviving. Now spot drops to $31. The paper market dips. Speculators take profit. Algorithms sell. The screen flashes red. But your cost is still $35. You can't lower your price to $31 plus premium because that would be $37. You'd be selling at a $2 loss. So you hold the price at $38. But now customers are angry. They see spot at $31. They see your price at $38. That's a 7-unit premium. They think you're gouging. They don't understand that you're selling old inventory purchased at higher prices. They call you a scammer. They leave bad reviews. Some of them wait, thinking the price will drop. Meanwhile, your supplier, the wholesaler, is not lowering their price either because they're in the same trap. They bought their inventory at $34. They're selling to you at $37. If they drop the price, they lose money. So the entire supply chain is stuck. Nobody can lower prices without taking a loss. The paper market can flash $31, but the physical market can't follow. It's locked in place by the cost structure of old inventory. This is why premiums are sticky. This is why they don't drop when spot drops. And this is why, over time, premiums only go one direction. Up. Now add another layer. What happens when you, the dealer, sell all 10,000 ounces? You need to restock. You call your wholesaler. You ask for 10,000 more ounces. The wholesaler says, I can get you 5,000 in 4 weeks. So now you have 2 choices. Raise prices to ration the remaining inventory, or go out of stock. Most dealers choose option 1. They raise the premium to $8, $10, $12. They slow the sales. They make the metal last longer. They wait for new supply. But new supply is slow. And if demand stays hot, the inventory never catches up. The premium never comes down. It just keeps climbing. Here's where it gets dangerous. At some point, the premium becomes so high that it breaks the buying psychology. Let's say spot is $30 and premiums are $15. You're paying $45 per ounce. That's a 50% premium. At that point, most retail buyers stop. They say, this is insane. I'll wait for it to come down. But industrial buyers don't stop. They can't. They need the silver to keep their factories running, so they keep buying. They pay $45. They pay $50. They absorb the entire available supply. Retail gets priced out. What happens to the retail market when retail can't afford to buy? It freezes. Dealers still have inventory, but nobody's buying. Sales volume drops. Dealers panic. They lower premiums to attract buyers. This creates a death spiral. Dealers can't sell at high premiums. They can't lower premiums without losing money. They sit on inventory, bleeding cash on storage and insurance. Some dealers go out of business. The ones that survive raise premiums even higher to cover the losses. The market becomes illiquid. Buyers can't find affordable metal. Sellers can't find buyers willing to pay the premium. The spread between bid and ask blows out to $10, $15, $20. At that point, the market is broken. The paper price might say $30, but you can't buy for less than $50. And you can't sell for more than $40. You're trapped in a no man's land. This is the end game of the Great Disconnect. Let me give you a scenario. Let's say industrial demand continues to grow. Solar panel production increases. Electric vehicles ramp up. Electronics demand stays strong. Industrial users are consuming 600 million ounces of silver per year. Mining produces 800 million ounces. That leaves 200 million ounces for investment, jewelry, and retail coins. But global investment demand for coins and bars is 250 million ounces. That's a 50 million ounce shortage. Every year, the retail market is short by 50 million ounces. Where does that shortage show up? In premiums. Premiums rise to ration the available supply. Now let's say a financial crisis hits. Stock market crashes, currency devalues, inflation spikes. Suddenly, everyone wants silver. Retail demand doubles to 500 million ounces. But supply is still only 200 million ounces. That's a 300 million ounce shortage. What happens? Premiums don't just rise, they explode. They go from $6 to $20 to $50 overnight. Dealers run out of stock in days. Mints can't keep up. Wholesalers have nothing to sell. The retail market goes dark. You'll see out of stock on every website. You'll see pre-order only, delivery in 6 months. You'll see premiums so high that the spot price becomes meaningless. And here's the kicker. The paper market will still be trading. The Comex will still show a price, but that price will represent nothing. It will be the price of a contract that can't deliver, a promise that can't be kept. A number on a screen that has no connection to physical reality. Hostile, the Great Disconnect will become the Great Decoupling. Paper silver and physical silver will be two completely different assets, and only one will be real. We are not at the breaking point yet, but we are closer than most people realize. Premiums at $6 are a warning sign. They're telling you that the system is under stress, that supply is tight, that demand is strong, that the physical market is struggling to keep up with the paper market's fantasy. If premiums go to $10, that's a red alert. If they go to $15, that's a crisis. And if they go higher, that's the end game. The banks will keep showing you $30. They have to. Their entire system is built on the illusion that silver is abundant and cheap. But the dealers are showing you the truth. They're charging $38 because that's what it actually costs to deliver metal. And as the disconnect widens, that $38 will become $40, $45, $50. At some point, you won't be able to buy silver at any screen price. You'll only be able to buy it at the dealer's price. And the dealer's price will be whatever the market will bear. In part 4, the final chapter, I'm going to give you the strategy. How do you navigate a market that's splitting in two? How do you protect yourself when the numbers stop making sense? And why, despite all of this chaos, physical silver is still the best insurance you can own. The disconnect is real. The math is brutal. But there is a way to win. Stay with me. Number 4, the strategy, surviving the split. If you've made it through parts 1, 2, and 3, you now understand the full picture. You understand why the screen says $32, but the dealer charges $38. You understand that this is structural, not temporary. You understand that the gap is widening and could reach a breaking point. So now the only question that matters is, what do you do about it? How do you position yourself in a market that's splitting into two realities? In this final part, I'm going to give you the playbook. The strategy for buying, holding, and thinking about silver in the age of the Great Disconnect. Rule 1. Forget the spot price. It's meaningless. The first thing you have to accept is that the spot price is not your friend. It's not even accurate. It's a benchmark for industrial contracts, nothing more. If you're a retail buyer, if you're stacking coins and bars, the spot price has zero relevance to your purchasing decision. Stop checking Kitco every 5 minutes. Stop waiting for spot to drop from $32 to $30. It doesn't matter. What matters is the out-the-door price, the total cost to get an ounce in your hand. Right now, that's $38. If spot drops to $30 tomorrow, your out-the-door price might drop to $36. You save $2. Congratulations. But you're still paying $6 over a number that doesn't represent reality. The better question is, what is the trend of the premium? Is the premium growing or shrinking? If premiums are rising, that tells you physical demand is overwhelming supply. That's a buy signal, even if spot is flat or falling. If premiums are shrinking, that tells you supply is catching up with demand. That's a wait signal. Right now, premiums are elevated and stable. That tells you the physical market is tight, but not panicking. It's a yellow light. Not a red light, not a green light. Yellow. Proceed with caution, but proceed. Number 2, buy physical only. Paper is a trap. If you don't hold it, you don't own it. This is the golden rule of precious metals, and it has never been more true than right now. The great disconnect proves that paper silver and physical silver are not the same thing. If you own SLV, the ETF, you own a claim on silver. A promise. A line in a prospectus that says you're entitled to silver. But can you redeem it? Can you walk into a vault and take delivery? No. You're at the mercy of the fund's rules, the custodian's inventory, and the fine print that allows them to settle in cash if they choose. Futures contracts are even worse. You're leveraged, exposed to margin calls, and playing in a casino rigged against you. The Comex can change the rules overnight. They can raise margins. They can limit positions. They can declare force majeure and settle your contract in cash at a price they determine. You have no control. Physical metal is the only form of silver that is truly yours. A coin in your safe is not a liability on someone else's balance sheet. It's not subject to counterparty risk. It's not going to be settled in fiat currency when the system breaks. It's yours. Completely. Permanently. In a world where the disconnect between paper and physical is widening, you want to be on the physical side. Because when the system splits, paper will be worth paper. Metal will be worth everything. Number 3, accept the premium. It's the cost of admission. I know $6 feels like a lot. I know it hurts to pay $38 when the screen says 32s. But here's the reframe. The premium is not a scam. It's the cost of converting paper promises into physical reality. It's the cost of security, insurance, logistics, and scarcity. If you want to own real silver, you have to pay real costs. There's no way around it. Think of it this way. If silver goes to $50 and you bought at $38, you made $12 per ounce. If you waited for spot to drop to $30 to avoid the premium, but premium stayed at $6 and you ended up paying $36, you saved $2. But if while you were waiting, supply dried up and you couldn't buy it all, you made $0. Or worse, you had to buy at $42 during a panic. You lost. The premium is the price of certainty. When you pay it, you lock in your position. You own the metal. You're no longer dependent on the market's mood or the dealer's inventory. You're done. You've exited the system. Compare that to waiting for the perfect price. You're gambling that premiums will drop, supply will improve, and you'll get a better deal. Maybe you will. Maybe you won't. But every day you wait is a day you're exposed to currency risk, inflation risk, and availability risk. The premium is not a bug. It's a feature. It's the market telling you that physical silver is valuable, scarce, and in demand. If premiums were zero, that would mean nobody wants it. Be glad you're paying a premium. It means you're buying something real. Number 4, stack consistently. Don't try to time the market. The worst thing you can do is try to time the perfect entry. I'll wait for $30. I'll wait for premiums to drop. I'll wait for a crash. While you're waiting, the market is moving. Supply is tightening. Premiums are rising. And one day you'll wake up and realize you waited yourself out of the market entirely. The better strategy is dollar cost averaging. Buy a fixed dollar amount every month, $500, $1,000, whatever fits your budget. Some months you'll pay $38, some months you'll pay $36, some months you'll pay $40. Over time, you'll average out to a reasonable cost basis. And more importantly, you'll accumulate ounces steadily without the emotional stress of trying to catch the bottom. This strategy works especially well in a disconnected market, because the price is no longer rational. It's driven by supply shocks, demand surges, and premium volatility. You can't predict it. You can only participate. By stacking consistently, you remove emotion from the equation. You're not buying because you think it's the perfect time. You're buying because you've decided that owning physical silver is part of your financial strategy. Period. Final thoughts. The truth behind the numbers. Banks show $32. Dealers charge $38. The great disconnect is not a theory, it's a fact. It's happening right now in real time in every transaction between a buyer and a seller. The paper market and the physical market have split into two realities. One is digital, leveraged, and abstract. The other is tangible, scarce, and real. One is controlled by algorithms and central banks. The other is controlled by supply and demand. One can be manipulated, the other cannot. You have to choose which reality you want to live in. If you believe the screen, if you trust the banks, if you think $32 is the real price of silver, then stay in the paper market. Buy ETFs, trade futures. Good luck. But if you understand that the screen is a lie, that the banks are hiding the truth, that the real price of silver is whatever it costs to hold it in your hand, then you know what to do. You stack. You pay the premium. You own the metal. You exit the system. The disconnect is not going away. It's going to get worse. Premiums will rise. Supply will tighten. The gap will widen. And one day, the paper market will collapse under the weight of its own fiction. When that day comes, the people holding paper will be left with nothing. The people holding metal will be holding everything. Banks show $32. Dealers charge $38. One is a lie. One is the truth. Choose wisely.